Be fooled by the mixed signals you see in the market. Remember, today's trade is temporary, but the investment is long. Things to pay attention to: the composite is under its 50-day moving average, the NASDAQ composite. The Dow's off about 545 points, somewhere around there. And the algos are going to kick in on the S&P 500, which has breached its 50-day moving average. So you're going to see some downside. It's bound to happen. The algos, remember this, once it's breached, it's almost like a no-look pass. There's no reasoning. There's no I'll wait till it pops over. They pretty much are signals to sell, if that makes any sense. The market is rotating defensively as we saw an 8.4% in home sales, signaling that consumer confidence may take a dip. So the big rotation is going to be defense, utilities, and real estate. While there's a 92% that the Feds are going to hold tight, of course, in their March meeting. Now, if you're watching the yield curve, well, the spread went from 53 last week to 48, which hurts net interest income with banks. So look for some weaknesses in financials. And while we're at it, February is typically a weak month, but it has a 53% win rate historically. And if we make it out of February alive, unscathed, we may actually be okay until at least maybe the summertime, right? If that makes any sense. Remember, NVIDIA is reporting on the 25th. And so they're the biggest bellwether because they're leading the market in tech, right? So we might have a little bit of a run and have some fun until that May number, but we don't know, right? They could just crash and trash the market based on the software narrative. You don't really understand, don't know, right? But you got to look at it going further in the year. If we're kind of fair to middling, we can have a pullback, a deep pullback in September and October, right? But remember, this is an election year. So what we're going to see in this case, typically historically says we see a double-digit return in the year. But that doesn't mean we win. It just means that's historic, right? History does not repeat itself. It just simply rhymes. Fun note, hedge funds are leveraged to the tune of 298%, while institutional allocations in cash is at 3.3%, which is a low, which means they have no reserves to buy the dip. It's almost like the perfect storm is brewing. So be very mindful, be very careful of what you're seeing. Bank of America's bull versus bear indicators at 9.4, which indicates, on a contrarian perspective, that there could be an unwinding in risk. New York Stock Exchange margin debt is levered to a tune of $950 billion. And the biggest short in the game is Tesla at 4.2